Joining me here, Post 9, Chris Hyzy, Merrill and Bank of America Private Bank CIO. Welcome back.
Thanks, Scott.
We tried to bounce today, and we're not doing that great of a job of it. We're only 33 points higher now on the Dow. Risk reward, still not good?
It's not bad.
It's not bad?
It's not bad, the risk reward. There's still a big fluid environment out there. We characterize it as being humid, which is there's a lot of distortions still trying to re-normalize. We all talk about them. Right now, that seems to be at the top of the list is yields, trying to re-normalize the back end, at least heading a little higher, putting pressure on risk assets. But I'm not going to say this is typical of a workout after a cyclical bear like we went, because nothing is really typical right now. You're not looking at typical capital markets repricing something in that we haven't seen in a long time. So for us, the risk reward is not bad. It's not great.
Well, how's it not bad if you point out what rates have been doing? It seems as, some are suggesting, as I read earlier, this Kolanovic note, Marco Kolanovic, right, that the fade the bond equity divergence. Bonds are telling the right story. Equities haven't woken up to it yet. Thus, risk reward for stocks isn't that great.
Well, I asked the question, what haven't equities woken up to yet? I mean, did the move last year indicate that where earnings deterioration is going to be this year? Maybe. And right now we're just backing and filling because investors are trying to reposition portfolios for the next cycle, not necessarily the cycle we left. So there's a lot of room to go there. And the big market cap sectors are what's pushing pressure down. But when you look at the old economy areas, the market cap there isn't as large, so we can't get out of our own way. So it's a backing and filling type of environment, and weakness this year, in our opinion, should be bought.
Oh, so you're a buyer of weakness, not a seller of strength.
That's correct. Yeah, we're a buyer of weakness to prepare for that next long-term bull market. And that should be driven by real earnings versus PE expansion. And if you get real earnings, that's a much better bull market than PE expansion.
Well, how much weakness do you think we might get that'll give you a greater opportunity to buy into?
There's 3 or 4 different big scenarios that can play out. I'm not going to even talk about soft versus hard landings because the reality is it's probably somewhere in the middle when you roll it all together. So you could see another 5, possibly 10% weakness. Regardless of what the weakness is in terms of its magnitude, we have to think about what's the driver after that weakness. And if you believe it's earnings and free cash flow, in equities at least, then you need to buy it. Now, secondly, in yields, there's a bull market in yields as well. Look at what the front end is giving us the opportunity to gain cash flow, to take that cash flow and reinvest it back into equities.
That's why I'm saying, like, people who say, well, the risk reward is better for stocks, then go right to, well, the bonds are attractive. Where's there more value right now, bonds or stocks?
Where's there more value right now in the very, very short term? For the next, say, 3 or 6 months or so?
I know, but those,
the front end of the curve.
But those opportunities have existed for the prior 6 months, too, have they not?
Not necessarily, because yields have been going back and forth. They've been on a constant move up at the front end. The back end is telling us that some sort of a recession's coming. So what do you want to do with duration? You probably want to begin to extend duration at these levels. Use the front end of the curve, get the cash flow, reinvest those in longer duration assets, which happen to be equities and the back end of the curve.
Give me your best, I got to go, but best idea in equities right now is what?
Old economy, energy and infrastructure.